Most Forex traders think price moves because of news, indicators, or manipulation, mostly manipulation. But you think that you are already too late. Money moves fast and money follows the yield. If you don't understand the yield, you are probably trading the result and not the cause. Today, I'll show you why the yield moves the Forex and how they control major pairs, why news react to the yield and not the other way around, and how to put yield directly on your chart. And this is where this guessing normally ends. My name is Dan, and make sure that you subscribe to this channel, and we're going to start right away after the intro. Now, what is a yield? A yield is actually the return on the government bonds. In plain English, we can say yield is actually the price of the money. It is actually what a country pays to borrow capital. And Forex is nothing more than money shopping for the best deal. Higher yield is equal to capital flow in, lower yield is equal to capital flow out. Forex is not chart first. Actually, Forex is capital flow. Now, let's talk about the most important rule. Here is the rule institutions normally follow. Number one, over time, currencies cannot actually escape higher yield. And that's why USD strengthens when the US yield rises, JPY weakens when the yield are actually suppressed. Emerging market currencies react violently to the yield shift. Forex is relatively yield game and not lock one. Why yield matters more than the Forex news? You can ask yourself that. Detailed traders normally chase the headline. Institutions normally watch the yield. Why? Because the yield already priced in rate hike, risk cut, inflation expectation, economic growth. That's why price often moves before even the news. News explains the price, yield, positions, money. Now, what's the difference between 2-year and 10-year yield? Because you only need two of these. 2-year yield is equal to what the central bank would do. 10-year yield is actually whether a bond believes them. Now, when these move fast, Forex of course move fast. This is why pairs like USD, JPY respect the yield more than indicators. Now, how does really yield move the major pairs? Let's just talk about that one. And for example, USD, JPY, US yield goes up, USD, JPY goes up. US yield goes down, USD, of course, JPY goes down. Intervention only pulls the move, yield decides the direction. Now, what about the Euro USD? Euro USD is actually a bond trend in disguise, okay? It is driven by the yield spreads between the US and of course the Europe. So US yield rising fast is equal to, of course, Euro USD falling. Europe yield catching up, of course Euro USD actually rising up. Watch the spread, not actually even the candles. Now let's talk about the gold, because definitely gold has no yield. When the real yield actually rises, what normally happens, the bond both pays better, gold loses appeal, gold falls. Gold does not really aid inflation, gold aids yield competition. Now, how to put yield on your chart is absolutely very simple. This is the most fact traders normally skip. You don't need to trade bonds. Step one, all you just have to do, go and open your trading view, click the search button on the left corner up there, and these symbols. Number one, US or Y, that is US 2-year yield, US 10Y, that is US 10-year yield, DE 10Y, that is Germany 10 years yield, JP 10 years, that is Japan 10 years yield. And compare the direction, not actually even the numbers. And the question you have to ask yourself, is it really rising or the falling? Is the momentum accelerating or the momentum slowing down? Now, overlay or go side by side. Put yield next to even the price. If the yield moves fast and price follows, you actually align with the real money. If the price disagrees with the yield, price usually catches up most of the time. And one thing to be clear about this, yield actually don't time entries. They set direction, and the most important thing, the pressure. Now let's just give you the example. Now let's bring this home. Kenya can actually raise interest rate and still see the Kenya shillings actually continuing to weak. Why? Because Forex is about the risk adjustment, okay? When the US yield rises, global money seeks safety. Capital exit emerging market. Even higher local rates actually can't compete with the safe US yield. Kenya is not actually competing with the Uganda or Tanzania. Kenya is actually competing with the US treasuries. That's why rising US yield is equal to the pressure the Kenya shillings increases the debt cost and tighten local financial condition. Kenya is actually connected to the global yield, and whether we like it or not. And let's ask yourself why this normally changes your trading. Number one, once you track the yield, trends make the sense. Fake breakout actually normally reduces. News becomes less emotional. You stop reacting. You actually start positioning. Indicators the correct chart, news explains the price, yields moves the currencies. That is the first thing that you really have to know. Now, if you're not watching yield, you are actually trading the shadow and not the source. Like the video, subscribe, and share this with the traders who still think Forex is actually random. I will see you in the next video. Make sure that you subscribe.